Imagine for a second that you're just scrolling through your feed and you see that classic Dubai real estate headline.
Oh, yeah. We all know the one.
Right. The $50 million penthouse,
Right.
the man-made islands shaped like palm trees,
Yeah.
or, my favorite, the Bugatti-branded hyper towers, where an elevator literally lifts your multi-million-dollar supercar directly into your living room.
It's pure spectacle.
It really is. It's all flash. And honestly, it's designed to be this blockbuster movie where you just sit back, eat your popcorn, and, stare at the wealth on display.
Right. It is the ultimate cinematic illusion of real estate. I mean, we gravitate toward it because we like wealth to be visible.
Exactly.
We want it easily categorized in these massive, undeniable, gravity-defying monuments. But it's an illusion.
It is, because if you step into the world of actual pragmatic wealth, building the kind of portfolio construction you're likely trying to execute right now, that blockbuster movie screen goes completely dark.
It has to. The math doesn't work up there.
Right. Because the actual math of building wealth doesn't usually happen in the penthouses. It happens in the quiet, dusty, emerging corridors.
Yeah, the transitional spaces.
Exactly.
Yeah.
It happens in those strategic suburban shifts off the major highways, where the concrete is still being poured and the infrastructure is just starting to click into place.
It is the absolute definition of finding value. You are looking for the exact moment when an emerging market is shedding its purely speculative skin and growing into a mature, fundamentally sound asset class.
Which brings us to the actual mechanics of the opportunity we are tearing apart for you today. Welcome to today's deep dive. We are bypassing the hype to look at a highly specific investment scenario in the UAE.
I've got a lot of data to unpack here.
A massive stack of sources for this. We're talking the August 2026 High-Yield Real Estate Investment Report, granular submarket data pulled directly from Bayut and Property Finder, and crucially raw, unfiltered investor sentiment from people who actually have skin in the game.
Real people, real money.
Exactly. So our target is a project that is generating just a massive amount of institutional noise right now. It's called Binghatti Skyflame, located in the Majan district of Dubai.
Right.
And specifically, we are going to dissect the financial engineering of their August 2026 promotional campaign, which centers on a 4% DLD waiver and a very unconventional 40/60 payment plan.
Yeah, and what's fascinating here is the broader macroeconomic context. Because the Dubai market in the second half of 2026 is entering a distinct stabilization phase.
Meaning the crazy spikes are calming down?
Precisely. We've just come off multiple quarters of rapid, dizzying price appreciation. Now the market is catching its breath. Institutional developers realize they can no longer rely purely on capital appreciation to sell units.
They actually have to offer a good deal.
They have to compete on financial structuring to capture liquid capital. So Skyflame isn't just a residential building, it's a real-time case study of how top-tier developers adapt their commercial strategies when a hyper-growth market transitions into a mature, stabilized cycle.
Okay, so to understand the building, we first have to understand the dirt it's built on, right? If you are looking at a map of Dubai right now, trying to make sense of the endless outward sprawl, you need to zero in on Majan. Our data shows it is a 15.6 million square foot master plan district sitting inside the massive Dubailand area.
It's a huge footprint.
It is. It's positioned as this gateway community right along the E311, the Sheikh Mohammed bin Zayed Road, and the E66, the Al Ain Road. And the commute times look highly pragmatic on paper.
Yeah, what are we looking at there?
Like 15 to 20 minutes to downtown Dubai and the Burj Khalifa, and 20 to 25 minutes to Dubai Marina or Dubai International Airport.
Which is incredibly well connected.
Right. But looking at highway lines on Google Maps doesn't tell the whole story. Why is this specific 15.6 million square foot patch of sand strategically important right now?
Well, you have to look at urban planning through the lens of comparative density. Real estate in a rapidly expanding city like Dubai is a game of alternatives.
Okay, break that down for me.
Let's look at Majan's immediate neighbor, Arjan. According to the latest Q3 data from Property Finder, Arjan is currently showing a very robust 8.62% gross rental yield.
Which is great.
It's fantastic. And average one-bedroom prices are hovering around 1.15 million dirhams. Arjan is bustling. It has the Miracle Garden. It has heavily integrated retail, hospitals, schools.
Sounds perfect.
It does. But as a result, it is becoming incredibly saturated. It's heavily built up. The traffic bottlenecks are worsening, and the barrier to entry for investors is rising.
So Arjan is essentially a mature asset at this point. It's priced for what it is today, not what it might become tomorrow.
Exactly, you're paying retail price. Now, pivot to the other neighbor, Liwan.
Okay.
Liwan is showing gross yields around 7.88%, with average one-bedroom sitting at a significantly lower price point, around 876,000 dirhams.
That's a big drop in price.
It is. But if you drive through Liwan, it's far less developed in terms of lifestyle amenities. It feels slightly isolated. It's more of a bare-bones commuter hub at this stage.
Which positions Majan as sort of the Goldilocks zone?
It is the transitional middle ground. Majan is an emerging, low-density alternative. It doesn't have that overbuilt concrete jungle claustrophobia that parts of Arjan are starting to suffer from.
Right.
But it has significantly more foundational infrastructure and master-planned lifestyle elements than Liwan. It is actively transitioning from an expansion phase into a complete residential suburb.
Okay, I have to challenge the premise here, though.
Go for it.
Because transitioning into a complete residential suburb, that's developer speak. I mean, for an investor sitting in London, New York, or Singapore, a 15.6 million square foot district off the E311 sounds like we are just buying raw desert and praying that civilization eventually decides to show up.
That's a fair fear.
Are we just banking on urban sprawl? Because buying on the fringes of a city carries massive vacancy risk if the population growth stalls. Like, what if no one moves there?
That's the most critical risk to assess, absolutely.
Yeah.
But the Brooklyn analogy applies perfectly here.
Okay.
Think about it. 20 or 30 years ago, if you bought real estate in certain outer neighborhoods of Brooklyn, you weren't buying the present-day reality of cafes and transit hubs.
No, you were buying warehouses.
Right. You were buying the mathematical trajectory of urban expansion. Majan is that trajectory, but with a massive de-risking factor. The foundational infrastructure is already poured.
Meaning the roads.
Yes. The E311 and E66 interchanges are fully operational. You aren't waiting on municipal budgets to build the roads. But the true catalyst, the element that takes this from a moderate suburban play to a high-conviction investment, is the transit infrastructure speculation highlighted in the investment report.
Oh, the metro line.
Exactly. There is active planning for a metro line expansion that would service the Majan corridor.
Now that changes the entire risk profile. I mean, a metro line completely alters the tenant demographic.
It completely rewrites the pricing paradigm. Think about the global data on transit-oriented development, or TOD. Whether you are looking at the Elizabeth Line in London, the Hudson Yards extension in New York, or historically the Red Line expansion to the Expo 2020 site in Dubai. When you break suburban isolation with rapid, heavy rail public transit, a massive premium attaches itself to properties within walking distance of those stations.
So it's a huge value multiplier.
Massive.
Mm-hmm.
If Majan gets a metro station, the capital appreciation of assets in that corridor is heavily insulated against broader macroeconomic downturns.
Because people always need to commute.
Exactly.
Yeah.
By acquiring an asset there today, you are buying the current low-density affordable pricing, but you are acquiring an embedded option on future high-density connectivity.
Okay, let's translate that embedded option concept for real estate, because that's a finance term.
Fair enough.
It essentially means you are paying today's price for an asset that has a hidden secondary lottery ticket attached to it.
Right.
Like if the metro doesn't happen, you still have a solid yielding asset near major highways.
It's still making money.
Right. But if the metro does happen, that ticket pays out massive capital appreciation that you didn't have to pay a premium for up front.
That is exactly how to view the risk-reward ratio of Majan in 2026. You are securing a foothold before heavy rail infrastructure permanently reprices the neighborhood.
But look, a strategically brilliant plot of land can be completely ruined if the entity pouring the concrete is incompetent.
Oh, absolutely. Location is only half the battle.
So let's pivot from the location to the builder. We need to decode the corporate DNA of Binghatti developers, because if you are going to leverage your capital into an off-plan or newly built asset, the developer's balance sheet is just as important as the floor plan.
100%. And Binghatti Developers is arguably one of the most fascinating corporate case studies operating in the Middle East today.
Yeah, their story is wild.
It really is. The company was founded in 2008 by Dr. Hussein Binghatti Al-Jabori, but it is currently spearheaded by his son, Mohammed Binghatti.
Yeah.
And under his leadership, they have completely disrupted the traditional development timeline in the UAE.
Well, the raw numbers in this dossier are frankly absurd for a privately held developer. I mean, listen to this. They have a portfolio of over 100 projects valued at roughly 80 billion dirhams.
Which is staggering.
That translates to about 21 billion US dollars. They have 30 million square feet currently in their pipeline. And if you look at their H1 2026 financials, they tripled their profit year over year to 1.82 billion dirhams.
Just in 6 months.
Yeah. They executed 8.8 billion in sales, moving nearly 12,000 residential units in just a 6-month window. They absolutely dominate the sub 2 million dirham segment.
They do. But, sales volume is an indicator of market share. But what institutional investors really look at is creditworthiness.
How safe the money is.
Exactly. In 2025, Binghatti secured credit rating upgrades from both Moody's assigning them a B3 and Fitch assigning them a B.
Okay, for someone not steeped in bond ratings, what does that actually mean?
In the real estate development sector, where cash flow bottlenecks and supply chain disruptions can easily bankrupt a mega project, an upgraded credit rating from global agencies is a massive flashing green light. It indicates deep financial health and operational liquidity.
Okay, but I have a logistical question. How does a developer actually build and hand over 12,000 units in 6 months?
Sounds impossible, right?
The logistics of that in a market like Dubai, where you are dealing with extreme heat, labor logistics, and material importing, it seems impossible for a traditional developer. What is the actual mechanism allowing them to move at this speed?
The mechanism is total vertical integration.
Okay, explain that.
Binghatti didn't start as a pure-play real estate developer. They have their roots deeply embedded in the contracting business. Because they started by actually building things, they kept that entire operational stack in-house.
So they aren't just the money guys.
Right. When a traditional developer wants to build a tower, they buy the land, hire a third-party architectural firm, put the construction out to a lengthy bidding process, hire a main contractor, who then hires dozens of MEP, mechanical, electrical, and plumbing subcontractors.
So many layers.
Yes. And every single layer of that adds weeks of administrative delays, profit margins, and counterparty risk.
So Binghatti just cuts out the middlemen.
They own the supply chain. They handle their own architectural design, their own structural engineering, and their own construction. They manufacture their own joinery, their own aluminum, and their own glass facades.
Wait, they make their own glass?
Yes. They do not have to wait 3 months for a third-party subcontractor to bid on a concrete pour. This vertical integration allows them to execute ultra-fast project delivery, compressing a standard 36-month build cycle down to 18 or 24 months.
That's crazy. And in real estate, time is IRR, internal rate of return. I mean, every month the building is delayed is a month of lost rental yield and trapped capital. So the speed is a massive financial advantage.
It really is.
But they also have this bizarre, fascinating brand strategy. I mean, if you drive down Sheikh Zayed Road, you instantly know when you are looking at a Binghatti building.
Oh, you can't miss them.
You really can't. They feature these highly aggressive, sweeping, geometric orange and white facades. But it goes beyond just architectural branding. They have aggressively partnered with ultra-luxury legacy global brands.
Yeah, this is a very unique play.
We are talking about the Bugatti residences, a Mercedes-Benz tower, a Jacob & Co. skyscraper.
Incredible projects.
But how does building a multi-million-dollar hyper-luxury Bugatti tower have any impact on a mid-market project like Skyflame down in Majan? Like, they seem completely disconnected.
Well, it's an aggressive application of the halo effect.
Okay.
By intertwining their corporate identity with brands that represent the absolute pinnacle of global luxury, precision engineering, and exclusivity, Binghatti elevates the perceived value of every single square foot they pour.
Is it psychological?
Completely. When a mid-market investor buys into Skyflame, they're buying into the exact same developer that the board of Mercedes-Benz trusted to execute their very first branded real estate vision globally. That halo trickles all the way down the portfolio.
It creates a brand equity moat.
Exactly. It helps maintain secondary market resale value and tenant demand, even in their more accessible, affordable tiers.
Okay, let's unpack this. I understand the marketing psychology, but I want to interject with some reality here. I don't want to just read the developer's glossy brochure.
We have to look at the full picture.
Right. So we scraped raw investor sentiment from forums like Reddit to see what people actually holding these assets are saying. And the reality of hypergrowth is always messy.
It always is. What's the ground level consensus?
So the positives align with everything we've discussed, you know. Buyers constantly praise the sheer speed of construction, and landlords note that the recognizable exterior facades make it very easy to market units to tenants.
They look good on a listing.
They do. But there are very real red flags raised by the community. First, multiple users pointed out that Binghatti's standard payment plans, usually over a 2-year construction period, are highly aggressive. And they almost never offer post-handover payment options, which puts massive cash flow pressure on the buyer.
That's a valid point.
Second, the architecture. Those sweeping geometric facades look great from the highway, but investors complain that the design forces the inclusion of massive, irregularly shaped balconies.
The form over function issue.
Yes. It eats significantly into the actual livable indoor square footage. I mean, you're paying for space you can only use a few months out of the year in Dubai heat.
Right.
And finally, there are consistent complaints about customer service bottlenecks and minor snagging issues at handover, purely due to the sheer volume of units they are pushing out.
And that encapsulates the exact trade-off every single investor needs to analyze. I often compare investing in Binghatti to holding a hypergrowth tech stock, as opposed to a slow, dividend-paying utility company.
Ooh, explain that dynamic. Because a tech stock implies volatility, but high reward.
Exactly. If you invest with a slow, traditional blue-chip developer in Dubai, you are going to get a white-glove, handheld customer service experience.
Yeah.
You will likely get massive, perfectly square indoor floor plans.
Very safe.
Very safe. But that project might take 4 or 5 years to build. Your capital's trapped, sitting dormant, fully exposed to multiple macroeconomic cycles before you ever see a tenant.
Which is expensive in its own way.
Exactly. Now, with a hyper-growth developer like Binghatti, you are prioritizing velocity. Your capital is put to work, the asset is built, and it is generating yield faster than almost anywhere else in the market.
But it's a bumpy ride.
It is. The customer service team might take a week to reply because they're handing over 12,000 units. The aggressive payment plans require your financing to be impeccably structured. You're explicitly trading a leisurely, highly customized build process for rapid execution and speed to market.
You're buying momentum.
Yes, you are.
And I guess if you know you are buying momentum, you can prepare for the administrative friction. So, all right, we understand the neighborhood, and we know exactly who is pouring the concrete and what their operational flaws and strengths are. Let's look at the actual asset. Let's walk through the physical blueprints of Binghatti Skyflame.
Let's do it. Skyflame is designed as a twin high-rise tower development.
Okay.
Conceptually, it is attempting to bring the luxury, highly amenitized resort lifestyle, usually reserved for prime coastal areas, into a much more accessible suburban price bracket.
Bringing the beach club to the highway.
Basically, yeah. The unit mix features studios, 1-bedrooms, 2-bedrooms, and what they have designated as royal suites.
All right, let's ground this in the actual numbers so you, the listener, have a baseline of what you are buying.
Break it down.
The studios start at roughly 401 square feet, with a price point around 585,000 dirhams. The 1-bedrooms range from 697 to 867 square feet, priced between 1.05 and 1.1 million dirhams. But the 2-bedrooms are where the sizing gets really interesting. They range from 12,217 all the way up to 2,234 square feet, starting from 1.6 million dirhams. And the royal suites exceed 2,000 square feet.
And what's the delivery timeline?
The targeted handover date is Q4 2027. We did see one isolated data source suggesting a Q2 delivery, but the overwhelming consensus of the financial data and the official payment schedules are hard pegged to Q4 2027.
Okay, so when you look at that sizing data, especially considering those Reddit complaints about balcony to indoor ratios, where do you see the strategic advantage for an investor?
I mean, looking at these floor plans, I'm zeroing in entirely on the 2-bedrooms. Over 1,200 square feet for a standard 2-bedroom is unusually generous for this specific submarket.
It really is.
Most developers building out on the E311 corridor are shrinking 2-bedrooms down to like 900 square feet just to keep the headline price under 1.4 million dirhams. This makes me think Skyflame is targeting a completely different tenant demographic than your standard transient investor unit.
Your analysis is spot on, and that is precisely where the hidden value lies.
Yeah. The Dubai mid-market is completely saturated with highly compressed, hyper-efficient layouts designed purely for the investor spreadsheet. Just tiny boxes. Tiny boxes designed to maximize gross yield on day one. But a 12,259 square foot 2-bedroom fundamentally changes who rents the unit. Right. It offers expansive open living areas, genuinely private bedrooms, integrated storage, and panoramic windows. This layout appeals directly to stable, long-term executive tenants or small families whose children might attend the schools in neighboring Arjan. So you are shifting your customer base from, say, a 25-year-old expat who will move out in 12 months to a 35-year-old executive who wants to stay for 3 years.
Exactly. When you buy a larger, more livable layout, you drastically reduce your internal rental competition.
Because there are fewer units like yours.
Yes. If the market dips, the tenant looking at a 900 square foot box will easily jump ship for a cheaper box. But a tenant embedded in a 1,200 square foot layout is sticky.
They don't want to pack up all their stuff.
Exactly. You reduce your vacancy rates, you eliminate the agent fees associated with annual turnover, and you stabilize your cash flow.
Okay, but here is where my investor brain starts flashing warning signs.
What's the flag?
I'm looking at the list of amenities in this building. Over 15 different luxury amenities. An infinity pool. Private sky pool terraces on select units, which, by the way, literally means maintaining water systems on a cantilevered balcony.
It's engineering intensive, yes.
It's terrifying from a maintenance perspective, plus padel courts, basketball courts, a spa, and ground-level retail. I mean, it sounds incredible, but amenities are liabilities disguised as luxury.
They absolutely can be.
If I own a unit in a vertical resort with 15 luxury touch points, won't the service charges and maintenance fees absolutely destroy my net yield? Like, who pays for the pool boy?
It is the most critical question an investor must ask because gross yield is a vanity metric. If operational expenses drain the account, the investment fails. And this leads us perfectly into the core of why we're analyzing this specific project today, the financial mechanics of the August 2026 commercial campaign. Because beautiful amenities and large floor plans only matter if the acquisition math works.
Okay, let's break down exactly what this August 2026 campaign entails for your portfolio. Historically, our sources indicate Binghatti standardizes on a 20-50-30 payment plan, or they run highly aggressive 70-30 structures where you are coughing up 70% of the asset's value while it is still just, scaffolding.
Right, which goes back to the cash flow pressure we discussed.
Right. But for Skyflame, in August 2026, they rolled out a highly optimized 40-60 payment plan coupled with a 4% DLD fee waiver.
And this represents a massive shift in their standard operating procedure and is entirely a reaction to the stabilizing macro environment we discussed earlier.
Okay, let's tackle the DLD waiver first because the impact is binary and immediate. Waiving that 4% Dubai Land Department fee removes a massive piece of acquisition friction.
It really does.
Normally, this is a hard cash tax you pay to the government on day one to register the property on top of your down payment. By the developer absorbing this, it keeps 42,000 dirhams in your pocket on a one-bedroom and 66,000 dirhams in your pocket on a two-bedroom.
Think about the time value of money there.
Exactly.
That is 42,000 to 66,000 dirhams of liquid capital that is not locked dead in a government registry. You can deploy that cash into high-yield fixed income, use it to cover the early installment payments, or hold it as an emergency reserve.
It's just free liquidity.
Yes. By eliminating this sunk cost, the developer directly lowers your initial capital expenditure. Mathematically, this immediately elevates your cash-on-cash return because the total denominator, your total equity tied up in the asset, is significantly lower for day one.
It's a pure cash injection into the ROI model. But look, the 40-60 plan is what I really want to pull apart here.
Let's go get into it.
The schedule works like this. You pay 20% on booking. Over months 1 through 3, you pay a total of 6%, that's 2% a month. Over months 4 through 17, you pay 14%, which is 1% a month.
Okay, so that equals 40% paid during construction.
Yes. And then comes the hammer. A massive 60% balloon payment due upon project handover in Q4 2027.
Right.
Now, I have to push back hard on this. You called this a structural benefit earlier, but relying on future bank financing in Q4 2027 carries massive interest rate risk.
It carries some risk, yes.
If I am buying a 1 million dirham apartment, I suddenly have to come up with 600,000 dirhams the day they hand me the keys. What if the lending environment tightens? What if mortgage rates spike to 7% by the time handover happens? This sounds like a trap disguised as a discount.
The interest rate risk is real, I won't deny that.
Sure.
But you have to view the 40-60 structure through the lens of risk transfer and capital leverage.
Okay.
The best analogy here is venture capital funding.
Okay, VC funding. How does that map onto a residential apartment in Majan?
When a venture capitalist invests in a startup, they don't give the founders 100% of the capital on day one.
No, they'd burn it.
Exactly. They provide seed funding to build the prototype. Then, Once the product is built and has traction, they provide Series A funding.
Okay, I'm following.
The 40/60 plan operates on the exact same logic. You are only exposing your seed capital to 40%, while the asset is an unproven idea sitting in the dirt. You are transferring 60% of the construction risk away from your personal cash flow and leaving it entirely on the developer's balance sheet.
So they have the incentive to actually finish the building.
Precisely. You keep the Series A funding the 60% balloon safe in your pocket until the asset has actual measurable traction. In real estate, traction means a physical building with a building completion certificate that you can legally put a tenant into.
Okay, I see the logic. You aren't paying the bulk of the money until the asset is fully de-risked and capable of generating revenue.
Right.
But I still have to source that 60% at handover. Where does it come from?
Yes, but because the 60% isn't due until the physical asset is completed, you leverage the banking sector to pay it. Banks in the UAE are significantly more eager to finance a completed, tangible asset than an off-plan promise.
Obviously, because they can repossess a real building.
Exactly. So upon handover, you take out a standard mortgage for the remaining 60%. You immediately place a tenant in the unit. The tenant's rental yield pays down the mortgage on that 60%, while your actual cash out of pocket remains locked at just the initial 40%.
Oh, wow. Okay.
Even if interest rates fluctuate, the premium rental yield of the building is designed to cover the debt service. It is a masterclass in utilizing leverage to artificially inflate your cash-on-cash return.
That makes the mechanics clear. The 60% balloon is essentially the runway you need to secure institutional debt once the asset is built, allowing the tenant to pay off the majority of the property.
That's the nuts and bolts of it, yes.
So we have the cost, we have the structural incentive, and we understand the risk transfer. Let's run the exact math. Let's look at the yield, the ROI, and how this benchmarks against the rest of the city.
Benchmarking is the only way to validate the pricing. Currently, the citywide median price for property in Dubai is sitting at approximately 1,450 dirhams per square foot.
And where does Skyflame sit against that median?
Well, the one-bedrooms in Skyflame bracket the median perfectly, sitting between 1,211 and 1,506 dirhams per square foot.
Okay, so pretty standard.
Yes. But again, the two-bedrooms reveal the true inefficiency in the pricing. The two bedrooms are priced between 738 and 1,355 dirhams per square foot.
Wait, 738?
Yes. If you target those larger units, you are acquiring the asset significantly below the citywide median on a per square foot basis.
That is a massive discount. So by below the median, rent above it, what is the rental data telling us for the margin submarket?
The current data shows standard one-bedrooms in Majan rent for between 65,000 and 75,000 dirhams annually. The two bedrooms rent for between 90,000 and 110,000 dirhams.
Solid numbers.
They are. However, because Skyflame is highly amenitized, because it offers that vertical resort lifestyle with the infinity pools and Bedell courts, the investment report model projects, it will command a 10% premium on rent compared to older standard buildings in the exact same neighborhood.
Okay, let's put it all together into a definitive financial model. I want to break down exactly what this 40/60 math means for your portfolio step by step using the one-bedroom model from the investment report.
All right, let's run the numbers. Let's assume an acquisition price of exactly 1,050,000 dirhams for a one-bedroom unit.
Okay, 1.05 million. Got it.
First, we project the revenue. Using the Majan baseline plus the 10% premium for the building's amenity density, the projected annual rent is 80,000 dirhams.
Okay.
Now, we must deduct the operational expenses, which directly addresses your fear of the 15 luxury amenities destroying your yield.
Yes, show me the pool boy fee.
The projected service charge is 14 dirhams per square foot. For an average 740 square foot one bedroom, that equals 10,360 dirhams annually in service charges.
Okay, 10K out the door.
Furthermore, any rigorous financial model must factor in a maintenance and vacancy reserve. The report allocates 5% of your rental income, which is 4,000 dirhams a year, set aside for internal unit repairs or brief void periods between tenants.
So let me do the math. We take the 80,000 dirhams in top-line revenue, subtract the 10,360 for building service charges, and subtract the 4,000 for our internal reserve.
That's right.
That leaves us with a net annual income of 65,640 dirhams. And if we divide that net income by our purchase price of 1.05 million, we hit a net rental yield of exactly 6.25%.
And we must emphasize the word net. The gross yield on this math is roughly 7.6%. But 6.25% is the actual highly probable cash-in-hand yield.
And is 6.25% net actually a strong performance metric for real estate in 2026, like objectively?
Objectively, yes. To understand the power of that number, you have to look at global fiscal policies.
Yeah.
We must remember the geopolitical and structural context of Dubai as a tax-free jurisdiction.
Well-
There is no municipal property tax levied on the asset itself. And critically, there is no capital gains tax or income tax on the rental revenue generated by foreign investors.
Which is huge if you're comparing it to Western markets.
It changes everything. If you generate a 6% gross yield in London, New York, or Sydney, that yield is immediately attacked. It is obliterated by high municipal property taxes, heavy state or national income taxes on the revenue, and exorbitant property management fees.
Right. A 6% gross in New York might leave you with, what, a 2.5% net yield?
If you're lucky.
Yep.
In Dubai, that 6.25% net is structurally protected.
You know, I want to circle back to that service charge calculation because comparing it globally really contextualizes the value here. 14 dirhams per square foot equals about 10,360 dirhams a year. If you convert that, it's roughly 2,800 US dollars, or maybe 2,200 British pounds a year.
Which is very reasonable.
Reasonable. It breaks down to about $230 a month in what an American investor would call an HOA fee. Think about the mechanics of that. For $230 a month, you are getting the maintenance of a travertine marble lobby, infinity pools, padel courts, a spa, and 247 security.
It's unheard of in the States.
Completely unheard of. If you try to find a luxury high-rise in Miami or London with private sky pools and a spa, the HOA fee alone will cost you $1,500 a month. It would completely erase your yield.
And this proves that the sheer density of a twin tower project creates an economy of scale.
Right.
It absorbs the massive cost of the amenities across hundreds of units, protecting the individual investor's bottom line.
Exactly. The economy of scale neutralizes the operational liability of the luxury amenities. The mathematical foundation of this investment is incredibly robust, with, one single caveat: the developer must deliver on their timeline and their quality promises.
This brings us full circle to Binghatti.
Right. We know they operate with vertical integration to guarantee speed.
We know their balance sheet is fortified by triple profits and credit upgrades.
We know their brand equity is being dragged upward by global luxury partnerships with Bugatti and Mercedes.
And we know that Majan represents a strategically located emerging canvas with the embedded call option of a future transit network.
Exactly. When you synthesize all those data points, this August 2026 campaign is revealed as a highly calculated maneuver.
It utilizes the DLD waiver to reduce upfront capital friction. It uses the 40-60 plan to transfer construction risk and maximize long-term debt leverage.
And it utilizes expansive two-bedroom floor plans to attract stable demographics. It is basically engineered to perform in a stabilizing market.
It's a very smart play.
It really is. The narrative of Dubai real estate is always dominated by the impossible headlines, But true portfolio growth requires ignoring the Bugatti penthouses and focusing on the underlying math of projects like Skyflame.
You have to look at the numbers.
Always. But before we end this analysis, I want to leave you, the listener, with one final provocative concept to consider as you evaluate this asset.
Okay, let's hear it.
We talked extensively about the halo effect, right? How Binghatti partnering with the absolute upper echelon of global luxury brands elevates the prestige of their mid-tier projects.
Yes, the rising tide lifts all boats.
Right. But let's extrapolate that trajectory into the future. As Binghatti's global prestige continues to skyrocket, as they cement their reputation as the go-to developer for the billionaire class, how long will it be until that very same halo effect permanently prices everyday investors out of their accessible projects?
Ooh, that's a very real possibility.
Right. If Majan secures its metro line, and Binghatti continues its relentless ascent into the ultra-luxury stratosphere, is August 2026 the closing window for entry-level access to this developer?
It's a question you have to ask yourself.
The blockbuster movie of Dubai real estate is shifting its focus, and you need to decide if you're going to take a seat before the opening credits finish rolling.
Well said.
Thank you for joining us for this deep dive. Keep scrutinizing the headlines, keep demanding the math, and keep exploring the hidden corridors where true value is built.